There's a tremendous amount of uncertainty very clearly in the oil market. What I would suggest is today there is zero geopolitical risk premium embedded in the oil price. I think merely we've recovered from beaten down levels where CTAs just drove the price well beyond what fundamentals would have suggested. So as we look today, we've got global oil inventories at the same levels as in 2018. We have demand despite tepid China, tepid certain areas in the world, reaching record highs in the month of December. And so the market's really grappling with, will we actually see a physical interruption coming from potential military action overnight, owing to the attack in Jordan, as you mentioned. But it seems like this market is completely apathetic towards that potential. There is no geopolitical risk premium embedded. And unless we see an actual supply loss, not just extension of voyage time and whatnot, but actual supply loss, there is likely not to be a discount, or I apologize, a premium placed in the oil price due to geopolitics.
Can I just ask you, because, we're seeing consistently now legislators in the United States, specific ones, granted, but consistently suggesting that it has to be Iran. There has to be some kind of major, force activity when it comes to Iran. If that was to be the case, and this is just obviously hypothetical, how severely would that roil global oil markets? Because I would imagine that would have to be consequential.
Very clearly, we have a White House that is completely very, very sensitive to a rising oil price. We saw that in them releasing the most amount of oil in history from their strategic political reserve when the world lost no Russian production. We've seen them give sanction relief to Venezuela with the promise that they'll have freer elections. We've seen that coming crashing down in reality. And so the easiest thing the Biden administration could do right now is enforce their very own sanctions. Amos Hochstein was commenting last week that they're doing pretty well with the sanction enforcements, yet Iranian exports are reaching a multi-year high. And so that would be the easiest thing, is for the Biden administration to enforce that. That could potentially remove as much as 1 million barrels per day from the market. Now, with that said, Saudi Arabia is sitting on spare capacity. They've removed volumes from the market, trying to stabilize the price, reduce volatility. And so one would think that if the market were subjected to a price shock in excess of $100, I think you would see Saudi Arabia under pressure to bring back some of those barrels. So there is a bit of a safety cushion right now, but that's lending itself up to a very, very tight market in 2025. We're seeing demand grow this year by about 1.4 to 1.5 million barrels per day. We see supply growth in U.S. shale, what should be a fraction of prior years. We see non-OPEC production outside of a few pockets, kind of matching expectations. And so while this may be a breather, last year the spectrum between bullish and bearish was measured in between 60 and 100. This year, most people expect a range-bound price with a view to much better pricing later this year and into 2025.